Welcome to a new webinar by the EU SME Center, an EU-funded project which, with the support of 6 implementing partners, support European SMEs that want to establish in the Chinese market. The center, currently in its second phase of activity, will run its support services until July 2019 and will continue to provide its knowledge to over 12,000 SMEs present on its database. Today's webinar topic is China's individual income tax reform. The reform includes quite a few changes that affect all levels of the individual income tax system, from its calculation to the application and enforcement. I would like now to hand over to Melody Ma from Deloitte China, who is here with us to clarify the changes in the individual income tax system, which will be entering into force as January 2019.
Thank you, Ilalia, and good day, everyone. I'm Melody Ma, Tax Director from Deloitte China. I'm from the Global Employer Service Team. We call it GES. I'm specialized in China individual income tax services to companies and individuals. You may find a little bit more about me in the slide. I'm happy to have this opportunity to share the very hot topic of IIT reform with you today. Firstly, let me give you an overview of the topics we will discuss in today's session. On August 31st this year, the 7th amendments to the PRC IIT Law were approved by the Standing Committee of the National People's Congress. You may be surprised to hear that it is already the 7th amendments to the IIT Law. The previous amendments did not arouse such intensive attentions from the society as this time. That is because the previous amendments did not materially change the original IIT law systems. They were mostly merely to adjust the standard deductions or modify the tax brackets for salaries and wages. The new IIT law under the 7th Amendment contains fundamental changes comparing to the previous amendments, and that is why we call it an IIT reform this time. In today's session, we will firstly share with you an overview of the IIT reform. Then we will lead you through the main changes under the reform in more details. After that, we will also discuss the potential impacts to individuals and companies under the IIT reform, and how individuals and companies may plan ahead of the reform before it takes full effect next year. Okay, now let's see Chapter 1, Overview of PRC Individual Income Tax IIT Reform. As most of you may already know that early this year, in the 13th National People's Congress held in March, Premier Li Keqiang announced the prospective IIT reform, which aimed to alleviate the tax burden on the majority of individuals. Following this announcement, on June the 19th, the draft amendments to the IIT law was submitted to the Standing Committee of the National People's Congress for deliberation and then was released to the Republic for consultation on June the 29th. With the facilitating channel open for a period of 30 days. After that, the draft amendments have been adjusted in accordance with the public opinions collected by the government, and the final version was approved by the government on August 31st. Together with the issuance of the new IIT law, the government also announced the early implementation of 2 amendments effective from October this year. One change is the application of the new standard deduction of 5,000 per month on salaries, increased from the original 3,500 per month. And the other change is the application of new tax tables on salaries, as well as income from operations. One thing is to note is the October here is from a payment perspective, meaning that the incomes actually received by the individuals in October would be eligible for the new deduction and new tax tables. If the income was received by the individual in September, while the tax filing is performed in October, the original deduction and tax table will still apply. Except the above two changes in the transition period, the other changes will take effect from January the 1st next year. Well, some of you may know that on October the 20th, the draft implementation rule to the new IIT law and the draft tax regulation for additional itemized deductions were also released for public comments. The solicitation period for these rules is 15 days, and then the channel will be closed on November the 4th. It is possible that the final version of these implementation rules may be finalized around late November or early December. This is the overview of the IIT reform. Then let's take a look at the highlights of the amendments to IIT law. We have summarized the main changes of the IIT law into 9 items. Let's have a quick overview of the 9 items first, and then I will lead you through each item in more details. Firstly, the tax residence rule is changed under the new law. From the next year, foreigners who have spent over 183 days in China in a calendar year will become a China tax resident. So, foreigners who work in China on a long-term basis or frequent travel basis may be affected by this change. Then, in terms of tax categories, the current IIT regime will be transformed from a schedular tax system to a more comprehensive system, meaning that certain items of income that are taxed separately will be combined and taxed on a consolidated basis. Meanwhile, the tax rates and brackets on certain income categories are also changed. Then, from a tax exemption perspective, except that the amount of standard deduction is increased, the new law also introduced additional itemized deductions, where certain basic living expenses are also taken into consideration in determining one's taxable income. Then, from a tax filing perspective, the resident individuals will be taxed on their annual income scale instead of on the monthly income under the new law. Payroll tax withholding is still required, but if the tax withholding agent fails to withhold tax from the individuals, or if the amount of withholding tax does not reflect the individual's final tax liability, individuals are required to file an annual income reconciliation tax return after the year end for any tax adjustment on a self-reporting basis. Then, from a tax administration perspective, to ensure that the tax authorities are equipped with necessary data for tax collection purpose, other government agencies would be obliged to assist the tax authorities in providing relevant information. In addition, the new law also introduced tax clearance requirement upon the Chinese citizens' emigration to the overseas countries if the Chinese citizen plans to deregister his or her Chinese household registration, which is called hukou in China. Well, the last one, the new law also introduced anti-avoidance rules. The basic rules are similar to those that apply for the corporate income tax purpose. Okay, here is an overview of the main changes under the new IIT law. Next, I will explain these changes to you one by one in more details. First, let's look at the tax residence rule. Actually, the current IIT law does not provide a clear definition for tax resident. The current law says a China domiciled individual or a non-China domiciled individual who resides in China for a full year is subject to China tax on both the China source income and non-China source income. Inferred from this description and by referring to other relevant tax circulars, a tax resident in China normally refers to a China domiciled individual and a non-China domiciled individual who resides in China for a full calendar year under the current IIT law. These individuals are subject to China tax on their global income. On the contrary, non-China domiciled individuals who do not reside in China or reside in China for less than a full calendar year are normally considered as a non-resident in China. Non-residents are only subject to China tax on the China source income. Here are a few principles I'd like to explain to you before we move forward. First, what is domicile? A China domiciled individual refers to an individual who habitually resides in China due to the household registration, economic interest, or family ties. Therefore, while Chinese citizens residing in China are normally considered as China domiciled individuals, foreigners, especially those who work in China on an assignment basis, are normally considered as non-China domiciled individuals for tax purpose. Therefore, in practice, we normally look at a foreigner's days of physical stay in China to determine his or her China resident status. The second principle is what a full year is in China. The full year test in the current IIT law looks at whether the individual stays in China for 365 days in the test year with temporary trips, which means a single trip of no more than 30 consecutive days or multiple trips of no more than 90 cumulative days outside China, not taken into account. Therefore, under the current IIT law, a foreigner who is absent from China for over 30 consecutive days or over 90 cumulative days in a year is normally considered as a non-resident in China for that year. The last principle is when we talk about China source income and non-China source income, how to define the sourcing location of an income. Please note that the sourcing location of an income is not the payment or cost location. With respect to the earned incomes, the sourcing location refers to where the individual provides services. For example, if an employee works in China for 30 days in September, his September salary is China source income, even if it is paid in other country. Similarly, non-China source income for an employee refers to the income earned from the overseas working period. Okay, now let's move forward to look at what are the changes for the tax residence rule under the new law. Under the new IIT law, there are two major changes. Firstly, the new law provides a clear definition for a tax resident, which is absent from the existing law. Secondly, the full year test will be superseded by the internationally recognized 183-day test for determining whether an individual is a tax resident or not under the new law. It means that from the next tax year, it would be easier for a non-China domiciled individual, say a foreign expatriate, to be considered as a tax resident in China if he or she stays in China for 183 days or more in that year. This change will affect many foreigners who work in China on long-term or frequent travel basis. You may have a question here. I am a foreigner and I have been working in China for 2 years, but I was never asked to pay China tax on my overseas income. Well, that is because the implementation rule issued in accordance with the existing IIT law provides a 5-year concession rule for the non-domiciled individuals. The 5-year here means 5 consecutive full calendar years with a full year rule before residing in China for 5 consecutive full years. Foreigners are normally not taxed on their non-China source income, which is not paid in China. As I mentioned earlier, that if an individual is absent from China over 30 consecutive days or 90 cumulative days in a year, that year is not considered as a full year in China. Therefore, in practice, it has been quite easy for foreigners to break the 5-year residence by being outside of China for over 30 consecutive or 90 cumulative days in any single year before reaching the 5th full year of residence in China. After they come back from the 30 or 90-day trips, their 5-year clock would restart from the next full year in China. Now, good news is that according to the draft implementation rule publicized on October the 20th, the 5-year concession rule will be maintained. The new rule says if a non-China domiciled individual has the record of spending over 30 consecutive days outside China during the 5-year residence period, the individual may still be exempted from taxation on the foreign source income, which is not paid in China. This would mean that the current rule of over 30-day single trip outside China to break one's 5-year residency will remain the same under the new law, while the other option of over 90-day cumulative trips will no longer exist. In addition, it is worthwhile to know that the draft rule also says individual needs to perform registration with the tax authority in order to enjoy the 5-year concession rule in the future. Thus, foreigners working in China should pay attention to such compliance requirement and perform the registration timely and properly in order to avoid not being able to enjoy the 5-year concession rule due to the absence of registration. Okay, let's move to the next topic. The next slide talks about the tax categories. As you can see from the pie chart on the left, the current IIT law uses a typical schedular system, according to which all taxable income is classified into 11 categories. The income under the different categories is taxed separately. The new law provides the following changes. Firstly, 4 categories of income are consolidated into a single new tax category called comprehensive income. These 4 categories are salaries and wages, remuneration for independent services, author's remuneration, and income from royalties. Under the current IIT law, different tax calculation methods are used for these 4 income categories. Salaries and wages are taxed at progressive tax rates from 3% to 45%. Remuneration for services, which is also called labor fees, are taxed at 20% to 40%, while the other 2 categories are taxed at a 20% flat rate. Now let's assume we have 2 individuals here. One individual only has salary income. The other individual has salary, labor fee, and also royalty incomes. They receive the same amount in total income and enjoy the same tax deductions. Under the existing IIT law, the second individual will receive higher net pay in his pocket, as he would be subject to a lower effective tax rate in consideration of different tax categories, while under the new IIT law, both of them will be subject to the same tax rates. So we can see that the new rule aims to promote social fairness with respect to income actively earned by the individuals versus to passive income, which is one of the positive features of the new IIT law. The second change on this page is that the production and business income derived by private, industrial, and commercial households is replaced by the term income from operations. There is no material change in terms of the nature and scope of this category. The next change is the removal of 2 income categories, namely income derived from contracting or leasing operations of enterprises or institutions, and other income. The incomes originally falling into these categories shall be consolidated into the other incomes, into the other categories, depending on the actual payment nature of the incomes. Therefore, the original 11 income categories is reduced to 9 categories under the new law. Now let's look at the change of tax tables. Same as for the salaries and wages, the consolidated comprehensive income will be subject to the progressive tax rates ranging from 3% to 45%, and still with 7 tax brackets, while the tax rates and 7 brackets remain the same. The lowest 3 brackets, including 3%, 10%, and 20%, would be broadened considerably. For example, the marginal tax rate on a monthly salary of 10,000 is 25% under the current IIT law, but it will be 10% under the new law. The highest 3 brackets, including 30%, 35%, and 45%, would remain unchanged. So even though everybody will benefit from the new tax table, the benefit would be more obvious to middle or low wage earners. All the 5 tax brackets are broadened for individual income from operations, while the lower limit, which applies to a highest rate, 35%, is increased from 100,000 annually to 500,000. The tax rate for other tax categories remain as 20% flat. You can have a look at the comparison of the tax brackets in the following tables. Next slide shows the change of standard deduction. According to the new law, the basic standard deduction that originally applied to salaries and wages also would apply to comprehensive income and would be increased from 3,500 per month to 5,000 per month, which is 60,000 per year for resident individuals. Meanwhile, the new law repeals the additional standard deduction of 1,300 per month that originally applies to salaries and wages earned by non-domiciled individuals working in China and domiciled individuals working overseas. The change signals the Chinese government's intention to follow the principle of national treatment in a wider scale. As I mentioned earlier, these changes would take effect from October on salaries and wages. The original tax rates for the other incomes in the comprehensive category will not change until January 1st next year. The next topic is additional itemized deductions. Firstly, as you can see on this page, we have summarized all the applicable deductions for comprehensive income of a tax resident. The itemized deductions refers to the statutory social security contributions and housing fund. There are 5 deductible items for the additional itemized deductions. They are children's education expenses, continuing education expenses, medical expense for critical illness, housing mortgage interest or rental, and expenditures on dependent parents. I think you may be curious to know what would be the scope, standard, and how to implement the additional itemized deductions. As I mentioned earlier that on October the 20th, in addition to the draft implementation rule, the draft regulation for the additional itemized deductions was also released to the public for consultation. According to the draft rules, we can see that, first of all, the government intends to provide a fixed deductible amount for most deduction items, except for the medical expense for critical illness. For example, the allowable children's education expense will be 12,000 per year for each kid, and the deductible housing mortgage interest will also be 12,000 each year. If an individual can enjoy the deductions under each of the qualified items, not including medical expense for critical illness, the total pre-tax deductible amount would be up to 4,600 per month in average. Secondly, the draft rules provide certain criteria for people to enjoy the deductions. For example, the housing mortgage interest is only deductible for the first set of housing purchased by the taxpayer or the spouse. The rental expenses are the rental expenses are only applicable if the taxpayer or the spouse does not own the housing property in the residence place, the expenditure on dependent parents is only deductible if the parents are over 60 years old, and etc. Thus, individual needs to review his or her own situation to determine the applicable deduction amounts. Thirdly, both the taxpayers and withholding agents need to make sure proper supporting documents should be collected and maintained, and proper registration or reporting should be performed with the in-charge tax authority at the first time claiming the deductions, and when there is any change of the relevant information. In summary, we can see that the draft regulation for the additional itemized deductions reflects the government's intention for equal treatment and to make the rules easy to implement across the country. Although the rules are not finalized and some issues are not cleared at this stage, such as whether educational expenses incurred overseas is eligible for deduction and etc., we can still say that the introduction of pre-tax deduction on personal expenses is a progress and milestone of IIT reform. One thing for sure at this stage is that many resident taxpayers can reduce their China IIT liability at different levels by utilizing the additional itemized deductions in the future. Some of you may have a question here. Under the current IIT law, foreigners working in China are eligible for tax exemption on certain benefits in kind, such as housing and children's education, which are also included in the additional itemized deduction items. Will the introduction of the additional itemized deduction have any impact on the benefits in kind policy for the foreigners? Well, there is another good news to reduce your concern about this issue. Before the release of the draft implementation rule, foreign employees and companies really were worried whether the existing regulation offering the tax-free benefits will be abolished, along with the adoption of additional itemized deductions. Now, the draft regulation for the additional itemized deductions specifically addressed that foreigners who have qualified children's education expenses, continuing education expenses, housing mortgage interest, or rental expenses may choose to either enjoy the new policy for additional itemized deductions or continue to enjoy the current policy for the benefits in kind, as long as the deductions are not taken twice for the same item. This may be an indication that the current policy for the non-taxable benefits in kind for the foreign individuals may not be affected. Another thing should be noted is that the itemized deductions and the additional itemized deductions are only applicable to a tax resident. If an individual is assessed to be a non-resident in China, neither of the two deduction items would apply. Besides the deductions mentioned just now, 20% of the income is deductible for the remuneration of services, author's remuneration, and income from royalties, and an extra 30% of author's remuneration can be further deducted. These are consistent with the current IIT law. Additionally, personal contributions to qualified commercial medical and pension insurance schemes may enjoy tax exemption or deferral within the prescribed months. Individuals' donations to approved educational programs or other charitable organizations may be tax exempted up to 30% of the taxable income in general situations. Now let's look at a case study here. Here is an example of the comparison of tax liabilities calculated based on the current IIT law and the new IIT law respectively. Say Mr. A is an Italian citizen and is a non-resident in China. He has a monthly salary of 50,000 and his social security contributions in China is 2,800 per month. If we don't look at other factors such as additional itemized deductions and other deductions, with the original tax table and deductions, his monthly China tax liability would be 9,000 965, nearly 10,000, with the new tax table and deductions, even though he is no longer qualified for the itemized deductions for being a non-resident. His monthly tax liability would still be reduced to a little bit over 9,000, which would achieve 865 tax savings to him every month. If he comes to a tax resident in China, and if he can take itemized deduction in his payroll, then the tax saving would be 1,715 per month under the new IIT law. That is an example to show you how people may benefit from the IIT reform. One thing should be noted is that being not eligible for the itemized deduction does not mean the individual is not required to make Social Security contributions. Based on the Chinese Social Security law, once a foreign individual has obtained work permit in China, the individual should be enrolled into the Chinese Social Security system and start to make social contributions within 30 days. It means that unless there is a Social Security totalization agreement between China and the individual's home country, which exempts the individual's social tax obligations, for a non-resident, he or she needs to pay Social Security contributions in China, while the costs are not pre-tax deductible. Okay, let's move to the next topic, the new tax filing requirements and timelines. This page covers all the major IIT filing requirements for an individual. I will only pick up a few items that may have impact on a foreigner in China. Firstly, a tax resident will need to do an annual tax return. As you may know that under the current IIT law, individuals whose annual income has exceeded 120,000 in the year are also required to file an annual tax return. However, the purpose of the two annual tax returns has a lot in different. In the current tax law system, because the IIT liability on one's compensation is calculated on a monthly basis, the original annual tax filing basically serves as an annual summary of the monthly tax reported via the employer withholding tax filings or via the monthly self-reporting. During the original annual tax filing process, if an employee finds out that he has a tax overpayment, normally he cannot make tax adjustment and claim a refund by filing the annual tax return. He or she still needs to have the local employer to adjust the original monthly withholding tax return and claim the refund on his behalf. Under the new IIT law, the annual tax return for a tax resident is a reconciliation tax return. The basic reason is, as mentioned earlier, the IIT liability on a tax resident will be calculated on an annual income basis from next year instead of on a monthly income basis under the IIT reform. Because people may not receive the same amount of income or incur the same amount of qualified expenses every month, there may be fluctuation of the applicable tax rates for their monthly withholding tax rates. Their final tax liability on the annual income may possibly be different from the accumulation of the monthly withholding taxes. In that case, people may need to do a tax adjustment by filing the annual reconciliation tax return in order to settle additional tax dues or claim a tax refund, and all the staff will be the individual's self-reporting obligation. The filing period of the annual reconciliation return is March 1st to June the 30th of the next year. Please be reminded that the IIT liability for a non-resident will still be calculated on a monthly income basis, so the annual tax filing will not be required for non-residents. The next point I'd like to mention is that if a resident individual needs to report the non-China source income in China, The tax on the non-China source income should also be filed between March the 1st and June the 20th of the next year. There is no monthly withholding or reporting requirements on one's non-China source income, unless the relevant costs are paid or borne by the China local employer. Under the current law, the annual tax return for 120,000 earning and the annual reconciliation tax return on one's non-China source income are two separate filings. It is still unclear at this stage, under the new law, whether these two filings would be consolidated. One point to note is that people can take foreign tax credit to offset the China tax liabilities on the non-China source income. In order to enjoy this tax credit, certain rules must be followed, and a copy of the tax completion certificate issued by the other country's tax authority must be submitted. The final point I'd like to mention for this page is that if an individual has reportable China source income but does not have a tax withholding agent in China, the individual needs to file monthly tax returns on self-reporting basis by the 15th of the next month. People cannot just file an annual reconciliation tax return in this situation. To summarize, for any China source income, which is the income earned from one's China working period, monthly tax reporting is still required under the new law, and the resident taxpayers may need to do an annual reconciliation tax filing for any tax adjustments following the tax year. For the non-China source income, normally, monthly tax reporting is not required unless the payment is made within China. It can be filed via an annual reconciliation tax return in the next year. Now let's look at an example here that illustrates the annual tax reconciliation mechanism for a resident individual. Mr. B is the resident in China. He receives a monthly salary of 50,000 plus quarterly bonuses. Assuming his China Social Securities are fully covered by the company, and he only has a standard deduction in his tax calculation, the total withholding taxes based on his monthly income and the final tax liability from the annual reconciliation will be different. The difference arises from the higher tax rates in the month when bonuses are paid. As a result of the annual reconciliation, Mr. B may have a refund of 7,500 by filing an annual reconciliation tax return for the year. Okay, let's have a quick look at this page. As I mentioned earlier, in order to ensure that the tax authorities are equipped with necessary data for tax collection purpose, other government agencies would be obliged to assist the tax authorities in providing relevant information. You can see from this picture for how many government agencies will be supporting the Tax Bureau in the tax collection. On the one hand, this information exchange system is that since the tax authority can obtain a lot of data from the other government agencies, it may reduce the reporting obligation and responsibilities of the individual taxpayers and the local employers to some extent. On the other hand, however, it will be easy and convenient for the tax authorities to trace most of the tax filing related information of the taxpayers. For example, if the tax return filed by an individual is incorrect, the in-charge tax officer may easily identify the errors and reach out to the individual for tax adjustment. One thing should be noted is that the individual taxpayers' tax filing records will be built up into the social credit system in China. Any tax non-compliance activities, such as late filing, late tax payment, or underpayment of taxes being identified by the tax authority, may affect the individual's social credit and therefore bring social or financial impact to the individuals. This will be a big challenge to most foreigners who will be a tax resident in China from the next year and need to file an annual reconciliation tax return. Well, remember the 183-day rule. Let's have a very quick look at this slide, which is not related to foreigners. The only thing I'd like to mention for this item is every Chinese person has a registered household in China. China does not recognize dual citizenship, so once a Chinese citizen has obtained another citizenship, this person is obliged to renounce the Chinese citizenship and deregister the household in China. However, many Chinese people don't want to do that for various reasons. So if you want to recruit an overseas Chinese person who has obtained another citizenship, and you want to send him or her to work in China, you may need to check if this person has deregistered the Chinese household during the recruitment. The main reason is that when you apply for the work permit for this person, if he or she still has the household issue, the local public security authority would ask this person to do the household deregistration first. There might be a chance that this person's tax issue may be brought up at that stage, and the work permit application process may be delayed, while the company's business may be affected. The last topic in this session is anti-avoidance rules. The new IIT law provides 3 situations where it may be considered as having a tax avoidance purpose. The Chinese tax authorities are empowered to initiate tax adjustment and collect underpaid taxes with interest surcharge to the individuals falling into these 3 situations. While in the current IIT law, there is no general anti-avoidance rules. In the past, the local tax authorities may make reference to the anti-avoidance rules in the corporate tax law when assessing an individual's income tax case. But because there was no supporting rules in the IIT law, there might be disputes between the tax bureau and the individual taxpayer in certain cases. Going forward, however, because the general anti-avoidance rules are added into the new IIT law, people in some situations will possibly face challenges from the Chinese tax authority if they have obtained tax benefit through commercial arrangements or related party transactions without a proper reason. Well, these are the major changes under the IIT reform, and you can see that some of the changes may have profound influence on the foreigners in China. Okay, next let's move to Chapter 3, Getting Ready for the IIT Reform. Actually, we have already covered some of the points on this page in the previous session. This page provides a summary of the key implications of the IIT reform from both the individual taxpayer's perspective and the employer's perspective, and which areas you need to consider to cope with the changes. Firstly, with respect to the new tax filing requirements, as well as the additional itemized deductions, which is part of the filing. From the employee's perspective, the method for computing taxable income will be significantly changed as the new law consolidates 4 categories of income into a new single category, which is the comprehensive income, and introduces various measures to reduce the overall tax burden on the individuals, such as the additional itemized deductions. To enjoy the tax benefits, individuals need to be familiar with the changes made to the IIT law and closely monitor any follow-up measures. In particular, the requirement to maintain supporting documents to claim additional itemized deductions. That is one thing. Another thing under the new law is comprehensive income by resident individuals will be assessed on an annual basis. Therefore, the IIT for resident individuals will be collected through advance payments withheld and remitted by the employer, plus a final settlement made by the individual in an annual tax return where applicable. Therefore, resident individuals will need to understand the new annual filing mechanism to ensure tax compliance, which may be very complicated to them. As I mentioned, that people normally don't calculate their own taxes in the current law system, while the employer has the obligation to deduct and file the correct tax amount on behalf of the employees to the tax authority. Therefore, some employees, especially foreign employees who also have the language issue, may need to seek professional assistance in their annual tax filing. From the employer's perspective, it should be noted that an employer's IIT withholding obligation will not be eliminated or mitigated under the new law. For example, an employer still will be required to withhold advance IIT on salaries and wages received by resident individuals on a monthly or transactional basis. In addition to the ongoing withholding obligation, according to the new law, if a taxpayer submits information relating to additional itemized deductions to the employer, which is the tax withholding agent, and requests the additional itemized deduction to be deducted in computing the advance tax to be withheld, the employer should not refuse the request. Although it is still unclear at this stage whether the employer has an obligation to verify the authenticity of the submitted information, the employer could have a heavier compliance burden by using resources to collect information submitted by the employees in relation to the additional itemized deductions, as well as to report to the tax authority in a proper and timely manner. In addition, it is required in the new law that the local employer should provide information of income and IIT already withheld to the employees, so that the employees can use the information for annual tax filing purpose where necessary. Actually, this requirement is not unique in China. For example, employers in the US are required to provide a W-2 form to employees and also to the federal and state tax authorities. The W-2 form summarizes the information relating to salaries and wages, income tax withheld, and medical and social security contributions in the last tax year. And this information is used by the employees to prepare the annual tax return. The introduction of a similar practice in China will increase the compliance burden on the local employers. Secondly, with respect to the tax residence rule, actually, we have already discussed a lot on the tax residence rule in the previous session. Tax residence is closely linked with an individual's China tax treatment. The new 183-day test could have significant impact on individuals, especially foreign individuals working in China on long-term or on frequent travel basis, if the individual fails to break the 5-year residency. The intensified tax enforcement and the anti-avoidance rules are quite straightforward. These rules, together with the coming financial account information exchange under the Common Reporting Standard rules, which we call the CRS rules, would significantly improve the China tax authority's ability to handle IIT cases, especially IIT avoidance cases. Foreign individuals, especially high net worth individuals with assets in China and cross-border business arrangements, should consider reviewing the overall tax compliance status and assess the sustainability of the tax position in China and abroad to manage any potential risk. In addition, again, it is important for individuals and withholding agents to understand the new IIT law to ensure compliance. You may consider to seek professional assistance as needed. Remember, any tax non-compliance in the future will not only result in financial the individuals, but will also affect the individual's social credit in China. In addition to the implications we just discussed, there will also be challenges to the people's management of the company under the IT reform. For example, employers will be facing challenges in assisting employees with their annual tax filing. It is common for business to provide support for the foreign employees to meet their tax compliance obligations in China and to facilitate their annual filings and initiate tax registration, which may be required to apply for a tax ID. Companies may need to review or set up new policies and process in this regard. Then you may have noted that the IT reform will affect different types of employees in different ways. For example, for the international assignees, there might be an impact on their mobility cost projections and planning, and the company may need to make an adjustment in the relevant part of the global mobility policy. For locally hired foreigners, the company may need to assess the impact on their local compensation and benefit package. And for senior management staff, the company may need to assess the impact on their compensation structure and compliance obligations, and etc. The HR team of the company should note this difference in dealing with different groups of employees and should consider to review or design different policies and benefit package for the different groups. Companies should also consider how the details of the IT reform will be communicated with the employees. For example, maybe you want to remind your foreign employees to consider the over 30-day trip outside China to break their 5-year residency before reaching the 5th full year in China. Then you may need to talk to the employees on the updated over 30-day rule. As we have discussed about both the employer and the employee's obligations, even if some of the changes under the IT reform will be the employee's obligation, the company may also need to provide certain assistance to the employees, such as informing them of their new obligations and how to fulfill their new obligations, especially the annual reconciliation tax filing. In addition, the company may also consider to give an advance notice to certain employees of the a possible impact on their payment package or their net pay. For example, the non-resident employees will no longer be eligible for itemized deduction for their Chinese Social Security contributions. This may be one of the impacts that the company may need to inform the employees in order to assist them in their own tax planning. To summarize the above, companies may consider the following actions to get prepared for the IT reform. Firstly, understand the new annual filing requirements and their implications to the employees. For example, with respect to the tax residence and annual reconciliation tax filing and etc. Secondly, conduct training and communicate with different types of employees about the potential impacts of the new IIT law. Thirdly, review the current internal policies and procedures to ensure the new compliance requirements can be accommodated. For example, the requirements relating to the additional itemized deductions and advanced IT withholding, and assess the impacts of the new IIT law on different groups of employees. Employers with large employee populations may also wish to consider the development of technology tools to automate the management process and improve efficiency. Although the final amendments to the IT law and the draft implementation rule have been issued, some questions still remain not answered yet, such as how to apply for a tax refund after an annual tax return is filed, and whether the current preferential taxing treatment for annual performance bonus and stock-based incomes will be retained or revised, and etc. Let's continue to keep a close eye on the progress of the IT reform. Well, that is the end of my presentation today. Thank you.
Thank you, Melody, for being here with us today and for sharing this valuable information on the amendments of the individual income tax. Thanks also to our viewers for being with us today. Should you have any further inquiry, you can contact us through our info@usmecenter.org.cn email address. For any inquiry related to a specific sector, you can reach out to our experts through the Ask the Expert channels, of which you can find the link down below in the info box. Also, do not forget to follow us on our social media channels to be always up to date with the changes in the Chinese market and with our next activities. Thanks for watching.